When the Jakarta Composite drops 32% in a single year and becomes the worst performing equity index among more than 90 tracked globally, that is not a regional footnote. The rupiah has broken through 18,000 per US dollar, worse than the depths of the 1997 Asian financial crisis. Global funds have pulled more than 3.2 billion Singapore dollars from Indonesian equities this year alone. Now here is the question nobody in the SGX dividend community is asking. How much of that pain is sitting quietly inside the stocks you are already holding? Every major port city in history has faced the same existential question. What happens when the trade route moves? For a retail investor managing CPF or SRS capital, this regional capital flight is not an abstract emerging market story. The forensic evidence shows it compresses Singapore dollar distributions right here on the SGX. I have been watching this one for a while, and the number that finally made me sit up was the currency translation exposure. Most financial content is built around excitement, chasing what is surging, what is breaking out, and what you might be missing. I am deliberately building something different because retirement-grade investing is not exciting. It is disciplined, forensic, and it is designed to still be working when you need it most. The currency storm moving through ASEAN trade corridors is about to show up directly on the kitchen tables of Singaporeans who depend on consistent dividend income. When the rupiah weakens through historical flaws, companies operating physical assets across the Indonesian archipelago see their local cash flows shrink when measured in Singapore dollars. A foreign currency translation haircut is a direct dividend cut. If your monthly expenses depend on stable distributions to offset rising utility rates, that distinction no longer matters. Before any dollar goes into the open market, it must earn enough to justify the risk over what you can get automatically at home. The CPF special account pays a guaranteed 4% with full capital protection. My personal sanctuary threshold remains 3.2%, and the minimum yield I require before any stock qualifies for a retirement portfolio is 4.7%, which is my forensic floor of 3.2% plus 150 basis points of equity risk premium. When translation drag from a collapsing rupiah reduces the net distributions of SGX-listed companies, the yield spread over that risk-free benchmark compresses, and the risk becomes unacceptable. The uncomfortable truth is that Singapore investors do not hold the Jakarta Composite directly, but they do hold the companies that rely on Indonesian soil, Indonesian labor, and Indonesian consumers to generate their headline distributions. Your physical plantations and industrial assets are located entirely within Indonesia, and their operating costs are denominated in rupiah. When the structural architecture of an immediate neighbor cracks, the compressed income arrives silently in your SGX brokerage statement. Institutional fund managers are currently treating the Indonesian capital exodus as an isolated domestic policy issue. The data tells a different story. The performance gap between a rallying broader Asia and a collapsing Jakarta Composite has reached a historical extreme. This is not a temporary dip. It is a structural verdict on regional currency stability that alters the value of every rupiah earned by Singapore-listed entities. The market is pricing these assets on historical Singapore dollar headline yields while ignoring the reality that the underlying earnings are being eroded by foreign currency translation. This is where the storm becomes a kitchen table problem, and the macro indicators show clear structural institutional abandonment. The Jakarta Composite Index is down approximately 32% in 2020. Global fund outflows have seen more than 3.2 billion Singapore dollars withdrawn from Indonesian equities this year. The rupiah breaking through 18,000 per US dollar represents extreme distribution translation risk for any cross-border equity allocation. The rupiah breaking through 18,000 per US dollar is our forensic linchpin. For a 55-year-old investor in Jurong East managing SRS funds, this number means that any asset relying on the conversion of Indonesian revenue into Singapore dollars is operating under real strain. Previous distribution levels are no longer a reliable guide for forward income planning. We need to look at individual sectors to separate the resilient balance sheets from the vulnerable ones. The currency deterioration requires an immediate reassessment of asset safety across SGX names with Indonesian exposure. In the palm oil plantation sector, Bumitama Agri sits in Zone 1 Fortress, while First Resources lands in Zone 3 Conditional. Meanwhile, Citrium remains a named watch item under close observation. Each stock on the SGX that Iggy covers is placed on a 5-point forensic scale to filter out structural yield traps. Zone 1 Fortress means the balance sheet is retirement grade. The yield clears the hurdle, debt is conservative, and interest coverage is strong. Zone 5 Red Zone means structural failure. The assessment is based on 5 hard gates: yield gearing below 35%, interest coverage ratio above 4 times, debt load, and the count of soft flags indicating emerging risk. Our macro scenario matrix outlines 3 potential paths for the regional currency corridor. The low probability bull case sees the rupiah recovering below 15,000 via central bank intervention, reversing translation headwinds. Our high probability base case keeps the rupiah stabilized between 17,500 and 18,500, creating bifurcated performance based entirely on balance sheet leverage. The medium probability bear case sees the rupiah breaking past 20,000, triggering widespread distribution cuts. 3 forensic questions to stress test your current portfolio. First, for plantation holdings like Bumitama Agri or First Resources, what percentage of the operating cost structure is exposed to rupiah inflation rather than US dollar insulation? Second, for maritime watch items such as Cetrium, does your portfolio thesis rely on an unverified order book narrative while ignoring the regional capital flight threatening future yard intake? Third, for your core CPF and SRS allocations, does the compressed yield spread of these regional equity names over the risk-free floor adequately compensate you for the lack of capital protection during a currency crisis? Retail investors routinely review historical balance sheets without separating the currency denomination of revenue from the currency denomination of operating expenses. The secondary effect the market is not pricing is the structural inflation that follows a severe currency breakdown inside domestic agricultural operations. When local input costs rise in tandem with currency depreciation, operational margins face a double squeeze that cannot be hedged away. And let's be honest, you are not just carrying equity risk, you are running an unhedged position on the Singapore dollar relative to regional operating expenses. Bumitama Agri is a case study in how balance sheet architecture determines macro shock absorption. The company delivers a headline trailing yield of 5.6% at a current market price of $1.78, confirmed via Investing Pro as of June 18, 26. Investing Pro's fair value estimate for Bumitama Agri is $1.77, placing the stock at approximately fair value with negligible premium. The distribution per share represents an all-time high, driven by stronger crude palm oil realization prices. The balance sheet metrics that support the Zone 1 Fortress verdict are straightforward. Gearing sits at approximately 15.1%, well below my 35% forensic ceiling. The interest coverage ratio is approximately 24.6 times, well above my 4 times floor, meaning the company generates roughly $24 of operating income for every dollar of interest owed. Net debt to EBITDA stands at 0.16 times, and free cash flow is 242 million Singapore dollars, marking 3 consecutive years of uninterrupted operational expansion with 0 soft flags. Our primary watch item is the Islamic medium-term note refinancing, scheduled for July 26 at a 4.20% fixed rate. The physical assets sit entirely within Indonesia, but the forensic distinction is in the revenue model. Crude palm oil is a globally traded commodity priced in US dollars. When the rupiah falls, US dollar revenue automatically translates into a greater volume of local currency, neutralizing the top-line translation drag that damages purely domestic enterprises. The primary vulnerability is on the cost side, where labor, transport, and processing are paid in rupiah. A prolonged currency collapse risks inflationary pressure on the operating cost baseline, which will be our primary watch item at the upcoming earnings release on August 13, 26. Investors frequently lump all Indonesia-exposed companies under a single risk category, assuming a falling currency threatens every local cash stream equally. For a global commodity producer, the currency dynamics run in the opposite direction. When the rupiah weakens, US dollar revenues translate into more local currency, not less. Bumitama Agri is not a rupiah stock wearing palm oil clothing. It is a US dollar revenue story with Indonesian operating costs, making it a potential beneficiary of translation gains when global commodity pricing holds firm. First Resources presents a starkly different forensic profile despite sharing the same geographical footprint and sector classification as Bumitama Agri. The trailing yield is 4.8% at a current market price of 3 Singapore dollars and 23 cents, confirmed via Investing Pro as of June 18, 26. Trading exactly at fair value. The ordinary distribution per share for financial year 25 was 14.70 Singapore cents with 0 special dividend components. The income is coming from ongoing operations, but the balance sheet architecture tells a far more leverage-heavy story. The core concern is the balance sheet following the ANJ acquisition completed in May 25. Gearing has risen to approximately 33.0% of total assets, trending upward toward my 35% ceiling. That is soft flag 1. The interest coverage ratio has compressed from a historical 32.9 times down to approximately 13.0 times, indicating a clear downward trajectory. Soft flag 2. Shareholder yield sits at negative 15.1% per investing pro. Soft flag 3. Three soft flags trigger a Zone 3 conditional rating regardless of the yield gate result. So what does this mean for you? It means the current configuration carries elevated risk relative to the income it offers. Two additional data points reinforce our cautious stance. Net debt to EBITDA stands at 1.10 times, while free cash flow compressed to 74 million Singapore dollars in financial year 25, reflecting the high capital intensity of integrating the ANJ asset base. For financial year 26, the dividend policy has been revised to distribute up to 60% of underlying net profit annually, down from the actual 64% payout seen in financial year 25. For this classification to improve, we need clear evidence of interest coverage stabilization and free cash flow recovery, making the August 14, 26 earnings release our formal review trigger. Pursuing an acquisition strategy using debt capital immediately before regional currency breakdown changes the risk mechanics of a commodity producer. Organic operations can absorb translation swings with relative ease, but leverage introduces fixed servicing costs that must be paid regardless of margin compression. Buying growth in a weakening currency environment with acquisition debt removes the structural flexibility that typically protects a palm oil asset, turning an operational hedge into a balance sheet watch item. Ctrim is presented strictly as a named watch item and does not carry a formal zone assignment within the current registry. The company maintains significant industrial infrastructure across the region, including its primary operational yards in Batam. When the regional macro environment deteriorates, capital flight across Indonesian equity markets directly threatens the domestic investment appetite that feeds industrial yard orders and marine infrastructure capital expenditure. To wrap up our assessment on Ctrim, we must separate short-term price movements from structural fundamentals. The 3% uptick on Monday, June 16, 26 is noise. The long-term reality is anchored in regional capital contraction. Until we can verify the exact cash generation within their Batam order book and run a full balance sheet audit, this name remains too speculative for a retirement income allocation. In this market, the difference between a sanctuary and a yield trap is decided in a single trading session. By the time this analysis reaches you as a free subscriber, the entry window Iggy identified has already opened and often closed. Iggy's elite investors do not just get the report earlier, they get it when the numbers still matter, with zero-day forensic breakdowns, the full red zone watch list, and institutional-grade cheat sheets at the moment the setup is live, not after the market has already priced it in. For 9 Singapore dollars a month, less than a kopi and kaya toast set at Raffles Place, you stop being the exit liquidity and start being the analyst. Link in the description. The shock absorption capacity across the SGX universe is determined entirely by balance sheet architecture, not by headline marketing statements. Both Bamitama Agri and First Resources have their physical assets on Indonesian soil, but the difference is entirely in the financial cushion. Bamitama Agri retains substantial insulation with gearing at approximately 15.1% and interest coverage at approximately 24.6 times. First Resources enters this storm with a thinner cushion, gearing trending up to 33.0% post-acquisition and interest coverage compressing to approximately 13.0 times. If you are still building your portfolio through monthly allocations, regional currency volatility is not a blanket signal to abandon ASEAN-exposed assets. Price dislocations can present opportunities to accumulate high-grade, naturally hedged assets with fortress balance sheets and zero soft flags. If you are already drawing down SRS or living partly off distributions, nominal yield figures are secondary to capital preservation and distribution durability over an 18-month horizon. Check your brokerage statements and make sure you are not concentrated in assets carrying multiple soft flags or compressed interest coverage lines. So what does this mean for you? It means auditing the underlying plumbing before the numbers force a change in your lifestyle. Are you certain that the Singapore dollar distributions funding your retirement are backed by genuine cash generation? Or are you holding an unhedged currency risk that could compress your wallet before the next earnings cycle? The structural lesson of the 26 regional currency breakdown is that headline yield figures are an illusion if you do not understand the geographical plumbing of corporate cash flows. A company can show an expanding distribution per share on an annual report while its underlying operating environment is preparing a margin contraction for the quarters ahead. The critical divergence is always found in the alignment between revenue denomination and fixed liabilities. Consider a 60-year-old retired investor in Panggol who relies on regional equity distributions to complement monthly CPF payouts. If that portfolio is anchored in high-yielding names without verifying balance sheet debt levels and interest coverage cushions, a cross-border currency shock will arrive as a sudden disruption to disposable retirement income. Capital preservation is not achieved by chasing the highest nominal return, It is won by auditing the financial foundation before the storm hits. Will your current investment allocation survive a prolonged regional capital flight? Or will you wait for the August earnings releases to find out which of your distributions were built on sand? This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.